Welcome back to the Execution Gap, the series of C-suite leaders where we done pretending that strategy and execution are same conversation. I am Mohammad Yunus from World Future Company. I am D365 financial system architect. I spend my days inside the guts of the mega projects, the ERPs, the consolidation engines, and the audit trials that either hold up under institutional scrutiny or collapse at exactly the wrong moment. My guest has been building the bespoke investments vehicles and the governance framework for over 3.5 decades. He is the chairman of Integer Wealth Global, a firm now recognized at the World Economic Forum level. But what makes him genuinely different from every other investment chairman I have announced? He started as a system architect. He wrote the operational system. He implemented the governance framework. He knows what breaks and what he has been fixing in 35 years. Ladies and gentlemen, there's none other than Dr. Marc Bandemer. Mark, welcome to the Execution Gap.
Thank you very much for your introduction and thank you for the accolades. I'm very humbled and thank you to be here this morning and for your kind invite. Thank you.
Thank you so much, Mark. So, Mark, before we get into the architecture of trust, what exactly the Integer Wealth Global and what do you mean when you say that you have built the perpetual financial machines?
Okay. Integer Wealth Global, I need to give a little bit of a backstory first. So Integer Wealth Global is a company that has several other member companies beneath it. And together with the member companies which belong to the group, together with our valued service providers and collaboration partners, strategic partners, and so on throughout Europe, we collectively produce bespoke investment vehicles. Now, just going back one step, if you look at our logo, it looks like a short zipper. But what it shows is that it actually indicates the coming together and the culmination of various stakeholders and those specific service providers in a collaborative format to deliver a desired outcome. So it's the coming together of many resources to bring one outcome for our clients. Now, the idea behind this was that in the landscape of investment throughout the world, the Western models have produced almost a plug-and-play type attitude as also a system which dictates how investments should work. What we have is that we've designed, and it's not just me, I stand on the shoulders of giants who have supported this and helped, and it is any accolade is due to all of them. So yeah, we're a collective partnership. So what we've done is that we've put together a model over the past several years, probably about 10, 15 years by now. And what that does is that it actually produces a vehicle based on the investment fund structure and alternative investment fund structure, where through it becomes attractive to institutional investors for them to invest through a robust risk mitigated platform into credible projects globally. Now, what does credible projects mean? It's defined on our website. I'm not going to go into that now, but a client, usually a corporate entity, approaches us and says they need a few $100 million to develop a new manufacturing plant or whatever. We would put together a bespoke, purpose-specific investment fund for that, which makes attraction for investors, institutional investors across Europe, and we would register such a fund in Europe, and it would operate from the providing capital, which is very highly managed and risk mitigated into the sustainable and credible projects. Yeah.
Correct. So when you are talking to a client, a project developer, an industrial group, or someone sitting on a credible asset, so when they come to you saying that I need to raise money, what's the first thing you have to correct them on?
This leads to this expectation of clients who require capitalization is always how the fund is structured. We do not take equity. It's not a debt structure. It's purely an investment structure. It's not any of the others. Now, that's the first thing that they all expect. How much of my company must I part with to be able to get capitalization for my projects through an investment fund or through a venture capital or whatever the case may be? Venture capital is exactly that. It provides, first of all, a smaller amount than what we speak of, venture capital, and then it is usually structured in a debt format. How this works is that we are simply the channel to provide investment of our own capital and that of our investors into a project for the express reason of a return. And the return does not always require a cash return or a monetary return.
Okay.
Because what happens is that if we have on our books this particular, on our balance sheet, this particular investment fund, it often requires only to produce value. Now, what's the difference between the value and the capital? The value can be leveraged, as per capital is only capital, it's only cash, where a lot of the clients, a lot of the investors that we have seek value instead of capital or cash returns. Cash is easy. Cash is also expensive. So if I give you 100 or 200 million euros and you turn it into 250 million, on my books, it shows that I have an asset or part of an asset that has 250 million. I have a 50 million profit margin. I don't need to take that. I can leave it there or I can reinvest it and so on. The asset value is usually what is the attraction, not so much the capital itself.
Got it. So, Mark, I wanted to share something with you before I ask the next question because this comes from experience, not theory. I've been called into the projects, serious, well funded, and legitimate projects where the capital structure is brilliant, the investment thesis makes sense, the team is credible, and then I open the ERP and what I see is noise, fragmented data across entities, cash flow reporting that does not reconcile, commitment schedules nobody can trace, and nobody can tell you in the real time where the money actually is. And I have seen the investment process stall, not because the investors walked away from the idea, but because the data could not survive due diligence. So I call it the 100 million leak, the invisible destruction of institutional trust through operational failure. So here is what I see as a D365 architect working with the mega projects. Brilliant investment structure collapses when the underlying ERP data, cash flow commitments, and the multi-entity consolidation is not audit ready for institutional scrutiny. So from your experience building these machines across multiple countries, where does the technical integrity usually break first?
I feel that that is an answer that is not one, there's not one answer. You have to take each project on its merits or on its results, and also who is managing those projects and with what platforms, with what methodologies, what is being used. So there is no broad brush that you can apply to a group of things. However, what we feel is that an inconsistency in the project management of such projects is often the issue, but that is on the client side. On our side, we have a very strong project management function as well, but that is simply to ensure that whatever capital is being drawn down from the client's investment fund actually reaches the actual destination. And that is something that we control. So everything and all these control measures are actually collaborative. So we have 4 to 5 different people that need to approve each transaction before our accounts department clicks or our treasury department clicks the go button for a drawdown that needs to go into the client's project. So what we've done as well is that not only do we create the investment fund, we also create a set of very specific bank accounts, which we collaboratively work together on. The problem, which means that we govern. So nothing reaches, none of the payments, none of the drawdowns does not reach the end destination. And that is governed and risk managed on a constant basis. It's really more project management than risk management. So we have schedules that where and when funds are being allocated to, and we make sure that that gets there and that it's there for the right reasons. So we take on that responsibility on behalf of the investment panel. So that is the way we do it. Others seem to have projects which then have other bleeding off avenues, and funds get allocated and get siphoned off to other things for other things and so on. And very quickly, both the communication and the fund distribution channel breaks down. And this is where I've seen it. I don't know how many times. So you need to have that consistency that I mentioned before I began this question, the answer to this question. You need to have the consistency right throughout. And then if you have, as we have, such a consistency, you need to duplicate that. And this is really a lot of what I'm saying is common sense. Right. However, unfortunately, when money hits the table, people change, but not in Integer Wealth Global. We've done this too many times. So yeah, fine.
Here is what I see as a D365 architect working with mega projects. Brilliant investment structures collapse when the underlying ERP data, cash flow commitments, multi-entity consolidation is not audit ready for the institutional scrutiny. So from your experience, building these machines across multiple countries, where does the technical integrity usually break first?
Okay. This is an answer with multiple answers attached to it. The reason for multiple answers is that the core issue usually lies within the jurisdiction in which the client projects reside. In other words, the technical integrity of where the client projects reside is subject to the laws, the processes and procedures of that institution. You can have all the correct processes in place: governance, project execution, risk management, etc. However, if a client project result is dependent on the jurisdictional laws, then these have to be navigated first, and that can defer investment and, of course, result from their own fund. It can defer investment from their own fund due to project readiness in various levels of the execution of the project. Okay, now, as an example, I live between Cyprus and the UK. The UK has an antiquated municipal law structure which they apply to construction or even just building project assessment called council approval.
Got it.
This is a technical obstacle which has to be navigated, as some of the projects wait for 2 years for council to approve or even longer. And these can be varied in size. It takes so much time. In that time, the investment gathers near zero traction. And the client then, together with us at IWG, have to find another application to develop value in that fund. This is the reason why we have each client and each fund for them created bespoke and with separate parameters unique to their objective, which cannot be compared to another client or their objectives either. The unique and the bespoke are the key words here. In Cyprus, on the other hand, construction and building projects are rapidly approved. Okay, as that generates work and revenue alike in the councils, and they apply pressure to complete all environmental impact assessments and so on, and any other approvals so that they can develop their environments at pace. Not so much in other countries like in the UK. Consider that this is only a single example, and the multitude of other considerations in the multitude of other industry sectors all have different considerations too, which is why I said in the beginning when I started this answer, there's many answers to this, and they have different spokes to them. So I hope that makes sense.
So you authorize the operational governance system for the South African government departments and the financial institutions. So when you are building the bespoke fund vehicle for a client, what operational controls must be in place before institutional capital flows?
2 primary controls in place release capital. There are more, but 2 primary ones. And this is on 2 further questions. Is the risk management and execution strategies, are they in place? And are they implementation ready? And if or when something goes wrong, are they available and can they be implemented according to either the policy for that particular project or whatever, such as weather or floods or fire or war or some catastrophic thing that happens? Are those risk management and execution strategies in place? That's 1. And 2, is the client ready? There's quite a bit of feedback from somewhere. Is the client ready? Client readiness is pivotal. It takes IWG 20 minutes to make 200 million euros available. It takes us 20 minutes to make
Great.
200 million available. The capital is dispersed into the client's investment fund and then deployed into the investment fund projects through a structured drawdown schedule, which is in essence a program of capital usage and which is monitored by the IWG risk management team. So several payments are often made in parallel to each other, depending on the drawdown schedule. Therefore, the two most critical operation controls are risk management and client readiness.
So I was about to ask you the same questions that might be a lot of audience needs to hear, but possibly uncomfortably. So what is the difference between the client who thinks they are ready for institutional capital and the one who actually is?
I can see I'm going to annoy a few people here. Forgive me, anyone who listens, but yes, that's a very good question indeed. And the answer really is that we see so many clients and have learned that some clients are simply more ready for institutional capital than others. The obvious factor dividing these two is always those who understand the IWG process and those who do not. Many large corporations have come and gone and do not understand the structures as they look through standard investment lenses and never see the ability of a unique and bespoke design investment fund or vehicle, for that matter, which serve unique and bespoke objectives and often attempt to force our model to comply with their understanding. When we began this conversation a few I said that the industry has developed into this plug and play type of
Right. Correct.
environment where we create something bespoke for a specific purpose. And what I mean by that, clients who require capitalization attempt to force our model into what they understand, and it's the other way around. If you look on our website, on the About Us page, under the legal and policy segments, there is a section there which shows a section of a policy which says the client must align to us so that we can drive the uniqueness of what we are doing for them together with them, as opposed to trying and do something in the way that they understand it and have been understanding it ever since day dot. So then we get the client who spends a week on our websites, processes all the information there, and engages with us for 45 minutes, and he's ready to move forward. So what's the difference then? Okay, so at this very different level, once again, it is the client readiness that makes the difference.
Correct. So, Mark, I have talked about what breaks. Let's talk about what you are building, because IWG just announced the Canada expansion with Kell Capital Partners and Riverstone Investments establishing for first investment banking license in Canada. So when you scale to perpetual machines modeled from Europe to North America, what changes in the governance architecture and what must stay constant?
Okay, the way I understand the question is, okay, so here's the answer. In the sense of your question, nothing changes in the management nor governance architecture. We've developed a governance architecture that is applicable to all Western jurisdictions so that we do not have any alterations in the management of our clients' investment funds. All clients, such as those mentioned, fall under the European governance system, which we have designed and refined over many years. We've taken this model, we've built it, and we've gone to each of the 11 jurisdictions in Europe that we work in and pass that through their legislator to say, this is how we do things. Are you okay with this? And from all of those 11, we've then put it together to have one unified system which now applies to all of Europe. And that's why we stay in Europe. However, if we had gone for a banking license in, let's say, the US, we could not use those same parameters. So Canada was kind enough to issue us a license for an investment bank. We still have to do a lot of work before that comes into being, and we've got until the end of November to produce our first operational documents for the investment bank. But that's fine. But we're using that based on the management structures and system that we've done before. And of course, what we're going to do is that we're going to passport that license into the United Kingdom and into Europe so that we can operate that banking license in these two jurisdictional areas.
Got it. Got it. So you have also joined the World Economic Forum. So how does that institutional recognition change the way of structure risk for global investors?
That is not yet clear. It's been a few days since we joined. Of course, what we trying to do here is to see how can we learn from any of these associations like the LAFV, Liechtenstein, the World Economic Forum, and other such institutions that we join. Although in the previous answer to the previous question, I state that a unified and global structure of management is applied by us, the World Economic Forum has so much resource that we hope to draw from going forward, and so continually refine our operations globally. So we are not at the pinnacle of our ability, okay?
Mhm.
And we never will be, as the world keeps changing, and so do the various jurisdictions in which we operate.
Got it.
So we obviously have to adapt, which then coupled with embracing all new concepts and technology, procedures, and making these our own, AI and all of that stuff that isn't. So we will remain relevant in what we do and how we do our work, to which the World Economic Forum will then have influenced us in a most positive manner. Their skill set, their accumulative amount of information that we draw from, resources that we draw from, and we'll adapt to whatever we can and however we can make ourselves better, faster, smarter, and sharper. And they are one of the resources providing that. So so we are always ready to learn and apply new knowledge which they provide us. So we're very honored to be members. Yeah.
Great. So really happy, and that's a extraordinary context, Mark. So I wanted to end with something fast and fun. I'm going to rapid fire 5 questions. Shortest answer you have comfortable with. So are you ready? Yeah. So biggest mistake you see in companies trying to attract institutional capital?
Let's see. Projecting, I would say, if they display or push forward or they project that their project instead of their company is ready for this. So is it project readiness or is it company readiness? You can have a great idea, but have a poor understanding of financial execution, especially under naive or arrogant expectations, such as because we have a great idea or project, we are due investments or capitalization. That type of attitude. So to me, to us, it's always client readiness. That also often used to apply to investor readiness. That is why we stopped using high net worth individuals or investments that require quick turnarounds. Our investment and our clients begin at a if it's a very small, but from 5 years onwards. So we look at the long game. 5, 10, 15, 20 years. In actual fact, as we said earlier, in perpetuality. So perpetuality means that it's forever ongoing. These investment funds can be heritage funds. Yeah. So, but the biggest mistake you see in companies is that they have a false sense of readiness until they meet with us, and then we upset them by getting them ready. It's part of our job.
Right. True. One governance framework every project finance leader should implement before seeking serious funding.
One governance framework project. So the one thing that
I will
remember that we originated from a risk management company. That's actually where we organically grew from that many years ago. So the lens that we look through, risk. The finance leader should always implement before asking for any capitalization risk. How are you going to mitigate the risk? Clients need to identify risks and be honest about them. Then develop a plan A, plan B, and a plan C to navigate those risks should they become factual. And that's what we do together with them. Everything we at IWG is done through the lens of risk, which is why we are trusted by institutional investors with millions of euros, because of robust risk management structures and principles.
What is the operational metric most investors overlook when evaluating a credible project?
There are none. There are none because not with our investors, as we are the risk managers for our investors. So they do not have to evaluate credible projects or credible clients. One of two of the things that we do is actually three of the things. Sorry, I'm increasing the number. The risk management that we apply is together with I always ask, when other people come with a similar concept that we have, I always say, so who does your rating? And they look at me and say, well, we do. I say, well, that's no. And who does your scoring? And they say, well, that's the same thing. It's not. So scoring is the evaluation of the feasibility and viability, those are two different things, of the projects inside the investment fund, which is rated. And for both of those, we either use Standard & Poor's or we use Moody's to evaluate them. What does that mean? What is the result? The result brings to the surface all the problems, all the challenges that these projects or this client could actually happen. And once we discovered all the pitfalls, it is how we, together with a client, put together the navigation paths through, not around, through those challenges which is bubbled to the surface in the due diligence and in the assessment of S&P or Moody's. That's the point. The point is to look at that, and then they say, okay, wow, we didn't know that. Well, that's all part and parcel of what we do. That's part of the risk management. So once you've established what the risks are, you can then manage them going forward. To determine risk is not a bad thing, and clients who require capitalization, oh no, this is a hard stop or a gate that we have. No, it's not. Investment companies, including us, are welcome to the fact that, guys, here's what can go wrong. But here's what we're going to do when it does, if it ever does. That is proactive.
Got it. So for entrepreneurs building the next 100 million plus industrial project, what's the first thing to get right?
The first thing that we always say is, and this again is a different approach to just about anybody else, transparency. Tell us what you are and not spare the gritty details, as it is what we as investors and investor representatives expect. It sort of goes a bit further from the previous question. We can work with transparency, as that tells us where the failings, possible crashes, and possible problems lie, and that we can then collectively work with to mitigate the exposed risk. So investors don't want to see risk-free nonsense, but rather honest and transparent, realistic projections, project details, and where are all the pitfalls. And then that is what we can collaboratively navigate. What is your level of transparency? So my is always transparency.
Love that. Best way for serious project leaders to connect with IDEP?
I think the best way to connect with us is through email sent to our info@integerwealth.global, or even our COO, Jonathan Reebein, can connect directly and quote that you obtained our details from this program. And we will always reply and assist wherever we can. Our door is always open. And even where we cannot help, we can at least advise where to go to or what to do next, by all means. And of course, have a look at the website. One of the things as well is that anybody coming to us, look at our website, go through the videos, so that you come prepared. Do not expect us to come to a meeting, especially with the senior executive committee members, and start asking basic questions. We expect people to come a little bit informed.
Got it. So, Mark, we agreed before we started today that we will end with something different, not rapid fire, not strategy, questions that don't get asked in a boardrooms, don't get asked at Davos, and don't get asked by anyone who has something to lose by asking them. So you have been in the industry for 35 years. You have set the tables most people never get invited to answer, and you agreed to answer these questions honestly. Okay. So I was on the question about the Western financial system. Wall Street, the City of London, European exchanges has spent decades presenting itself as the gold standard of investment governance, transparency, and institutional trust. But we have had 2008 SVB, the LME nickel scandal, and the $1 billion funds collapsing while their managers collected fees. Meanwhile, the Saudi Arabia is deploying the most ambitious sovereign capital program in the human history, faster with more stated discipline and with less public scandal. then Western markets manage a normal quarter. So, Mark, you operate between Luxembourg to London and now North America. Honest answer on record: is the Western financial system still the global standard, or has it been living off a reputation it stopped earning 20 years ago? And is the Gulf quietly building what actually comes next?
That is a very deep question. My assessment of that is arrogance and greed resulted in recklessness and disillusion, which was the catalyst of most of the failures that you mentioned. The origin of this is due to the culture of which that arrogance is cultivated in. The result is now history. However, the consequences are not. We still feel the consequences of that. And we're still moving out of that drama which it created. But nothing's changing. The system is not changing. This was indeed living, as you said, off a reputation that it inherited, and indeed also stopped earning that reputation many years before the collapse of the financial industry. So if you look at the three main reasons why the 2008 crash happened, which is interest-based debt expansion, there's risk transfer via securitization. Okay, that's all standard, but it's all nonsense. And then the speculation detached from real assets.
Right.
So a useful way to frame that is that the most common moral value difference between financial systems and governance in the Gulf states and the Western world, especially the USA, is how profit, risk, and responsibility are morally justified. So now we're going into a bit of a nebulous framework here. Nebulous
Okay.
meaning intangible.
Okay.
So therefore, the core moral in one sentence, the Gulf states work on a principle that profit is morally legitimate only when linked to real economic activity, shared risk, and ethical limits.
Exactly.
Where the United States and the West, which is the dominant Western model, worked on the principle that profit is morally legitimate as long as it is legal and contractually agreed, even if risk and social costs are unevenly distributed.
Correct.
So there is a moral issue at play there. Okay, which the Gulf states looks at through a moral lens. Then there is the money as a moral instrument versus it being a neutral commodity.
Correct.
Money is not considered something that should generate more money by itself. It can't. Earning a guaranteed return purely for lending based on interest is viewed as morally problematic because it separates gain from productive effort and risk. In other words, wealth is treated as a trust with social obligations and not just private property. In the US or Western systems, money is treated as a commodity that can be rented, priced, or traded, and so forth. Is morally neutral. It is simply the price of capital. The system, therefore, assumes voluntarily that contracts are sufficient to justify the outcomes. So, is the moral contract? The contrast is profit justified by consent alone, or by the fairness in how risk and value are created. So, which is it? Because risk, the shared responsibility versus risk transfer, in the Gulf states, the moral legitimacy in the Gulf states comes from risk sharing. Financing should require that the financier bears meaningful exposure to loss. This means that the Gulf states take an actual responsibility. This embeds a moral expectation of partnership rather than domination by an institution such as a bank.
That's right.
In the United States, risk is commonly transferred and not shared. Lenders are entitled to repayment regardless of borrower outcomes, and losses are often socialized during crisis, while gains remain private. How imbalanced? Moral contrast: should one party be allowed to profit without sharing the downside risk? Well, a little bit further. Governance, important caveats, and other things apply to US models. I can go on in detail here, from fiduciary duty to disclosure to shareholder rights to ethical concerns and so on. But the point is that there is a moral lens which is being avoided. In the Gulf states, it's not. In the Gulf states, it's part of the financial system. In the West, it's actually not included at all because it's deemed as nebulous.
Got it. So I want to speak on the wealth architecture. There is approximately $300 trillion of wealth in the world. Roughly 2,000 people control more than of it than the bottom 60% of humanity combined. So you build the machines that structure and move institutional capital. You understand the architecture of how wealth concentrates better than almost anyone. So here is the question that never gets asked of someone who actually understands how the system works from the inside. Is this the current global financial system designed to create prosperity, or it designed, whether intentionally or structurally, to maintain concentration at the top while giving everyone else just enough return to stay invested and stay quiet? And Mark, you have spoken publicly about the faith guiding your journey. What does a man who believes in something greater than the capital do with the honest answer to these questions? Yeah.
You said something very important there. You said the concentration of wealth at the top while giving everyone else a little bit in return to stay invested and stay quiet. That is very true. A man of faith, I can quote many Bible verses, but that's neither here nor there. My answer, which I arrive at, is seeing through the lens of my character. So at least that part which I'm consciously aware of. So the answer to this is a bit opinionated. Pardon me. The fact, although, that there is more wealth at the small top few, whether they are companies or individuals, rather than at the bottom masses, it's true. However, that does not make the system inherently incorrect or unbalanced or evil. Is what those who own such wealth, we are therefore tasked with the responsibility of distributing that wealth for the benefit of lesser abled nations and their peoples. However, the solution does not lie in distribution alone. The empowerment has to happen. It doesn't lie in distribution. The empowerment of the people is what matters. In my personal opinion, my assumption, it is educational empowerment of women and the education of children that has to be placed at the forefront of every African, every other nation. Doesn't matter if it's Africa or anywhere else, but especially in it. Only then can the seed, which are the children, seed I refer to are the children, grow into effective leaders and govern with compassion and foresight. I want to just say one last thing. It is not to sell us or anything. If I stand by what I have said in this interview, then what are we as a company doing to adhere to our own core values? This is why we have the Victoria Lilly Foundation. If you look on our website under, I'm not sure, but it's on our website under the About Us section. There is a section where we illustrate the Victoria Lilly Foundation. So if you go to www.victorialilly.foundation, you'll see what it is that we do in this regard. We cannot have a profit-only incentive. There must be something we do with it, and that is what we have created so that we can channel what Integer Wealth Global does into that as a charitable redistribution of wealth. And that's actually the whole purpose of Integer Wealth Global, is to provide not just for ourselves, we also have a good life and we enjoy being paid well, but there is a limit. We've got to pay it forward. And that's the mechanism we use. So it helps nothing if I sat here and told you all these wonderful things about how my values are, lenses and all that stuff, if we don't do it ourselves. So that's where we do it. I thought I'd just qualify it. Thank you very much. That is it. Thank you, everyone who's watching. God bless you all. And I hope to speak to you soon.